At the moment there is a lot of noise, particularly around US-China trade wars and the unresolved Brexit situation. I think obviously created some nervousness in markets and I think we're sort of entering a period where we might see a bit of volatility. The question is how long does it go on for, and I guess what's the collateral damage. Obviously we're starting to see GDP slow down, we're starting to see disruption in supply chains already. I guess all you can take from that is that, you know, on balance over time, a lot of these geopolitical events tend to wash through and the fundamentals of markets tend to come through. So again, we have methods to protect portfolios and protect risk if there is a downturn, and look, there should, in the growth part of portfolios, clients should expect markets to be negative once every 4 or 5 years, and certainly we expect some volatility in the coming years. But I guess the assurance you should take out of that is that risk management has been built into portfolios. You know, retreating to cash is a very expensive form of insurance. You know, you're going to go back to 1% rates, so we think there are better ways to manage risk. Intrinsic to what we do is a asset allocation model that's based on a client's cash flow that is essentially designed to help withstand most market fluctuations. So with the growth part of a portfolio, volatility is expected from time to time. We have this structure that means you don't necessarily have to pick timing of market turning points. That being said, I guess there are things we're doing within the asset allocation framework. We do acknowledge that our long range forecasts for most risk assets are still okay, probably with the exception of the US equity market, which we're sort of steering away from. Other areas such as fixed income or fixed interest that carries long what we would call duration or interest rate sensitivity. So that's another area we think where probably the risk reward payoffs are not justified. We have this, what we believe is a robust overall process that should cater for all markets, and then we'd also use the information that we think is reliable enough to tilt the portfolios in certain ways. Look, number one tip, speak to your advisor. Your advisor's getting all the information firsthand from the investment committee, which is our central source of information. We've got 2 external consultants that sit on that investment committee that give us an expert and an impartial view of the world. So that's our forum to just sort of distill all the information and apply it to portfolios, and the advisors are getting that information firsthand. So hopefully nothing that comes around the corner is a huge surprise.